Are you a multifamily landlord looking for an alternative investments to multifamily properties? Maybe you're looking to exit multifamily properties altogether, but what do you exchange into when you have capital gains tax to deal with? Maybe you're in a 1031 exchange. You would like to 1031 exchange, but you're not necessarily interested in reinvesting into multifamily properties. What options do you have? You still want monthly income, you want appreciation, you want tax savings. Today's episode is for you. We're talking DSTs. Stay tuned. Hi, this is Chris German, and welcome back to the Apartment Dealer Show. Today, we're going to discuss Delaware Statutory Trusts. I'm sure you've heard a lot about them. It's a great alternative investment vehicle to multifamily properties, and they're structured as such for those individuals that are looking to slowly exit out of multifamily ownership, or for those individuals that are looking for an alternative to multifamily properties. You'd like to sell a property or properties that you currently own and get into an asset class that's more passive, where you're not taking the phone calls and there's not rent control and all these other factors that affect multifamily today. That's what we're going to discuss. I'm going to take you to live footage from my most recent Apartment Owners Educational Luncheon. This is where I and a handful of professional speakers and about 200 landlords like you get together to discuss what's impacting multifamily investment, what's changing, what are the market trends, and so forth. And then, of course, all different facets of investment strategy so that multifamily landlords are prepared to take their financial legacy into the new year. Well, we're taking you again to footage from my most recent event. And with us will be Mr. John Taylor of JRW Investments. Now, JRW is a local investment firm here in Pasadena, California, and they do all things DSTs, again, Delaware Statutory Trusts. We were introduced actually to this company from a personal client of ours. And since then, several years ago, they've spoken at our events. We've had several clients of ours sell multifamily properties, do 1031 exchanges, and invest alongside them. And they're quite happy with the final result. So for you though, maybe you're unaware of how does a DST actually work? What type of properties do they own? How does it qualify for a 1031 exchange? If you invest in a DST, well, then how do you exit once the hold term has been complete? John is going to cover all those questions and more. Let's go to that footage now.
Good afternoon. So happy to be here. Chris and his team, thank you for having us back. Today, my goal is in about 20 minutes to give you a high-level overview about the structure and the strategy of a Delaware Statutory Trust. I could take quite a bit longer than that. And so I'm probably going to rush through structure and strategy in lieu of being extremely practical. JRW is located right here in Pasadena. We serve about 2,000 investors. We focus on other vehicles besides Delaware trusts, but the through line is that it's real estate, it's held for investment, and oftentimes it's packaged as some form of security. Disclosure, this is educational. This is not promoting a specific offering, although we're going to use an offering as an example and as a case study. We're mission driven at JRW. Oftentimes we have investors who are coming to us with a problem and they're looking for a solution, and we provide them with an opportunity. It's encouraging for us when we're looking at the retired investor who is focused, number one, on security and stability of their legacy wealth. And when we can provide that, it gives them the freedom to enjoy the life that they had imagined through retirement. And it's additionally encouraging to see how they're motivated with their legacy wealth beyond their lifetime. They're often generous with their family members, with their charity, with their church. We do two things. We protect wealth and we grow wealth through real estate. We do that in a variety of different ways. The purpose of this presentation, so if you want to check out of the next 15 minutes, you can. The purpose of this is for you to walk away out the doors after this presentation with an idea of how to solve the retirement problem of multifamily real estate investing. Oftentimes, if you spent your entire life maximizing your real estate portfolio, growing your real estate portfolio, you're thinking about, okay, now what do I do to prepare? And preparation, let's say you worked with Dave and you have done a cost seg study, you've reduced your basis significantly, you've purchased another property through a 1031 exchange, you've done that over and over and over again, you've accumulated a massive gain. And you might go to Chris and say, I'd like to sell, but how do I do that? How do I walk away? 30%, 50%, depending on where you're leveraged, of your profit in your lifetime's work could go away due to taxes, capital gain tax. So the 1031 exchange, many of you have used, many of you are planning to use. Long-term, the additional bonus to the 1031 exchange, you've heard the term maybe swap until you drop. The legacy planning and wealth management component of end-of-life estate planning within the structure that I'm going to talk about is of particular interest. The Delaware Trust it leverages a grantor trust. Many of you may have living trusts. The IRS in 2004 deemed that this is like-kind property. So this is a 1031 exchangeable offering. It allows you to have fractional ownership in one or many properties. The companies that put these together are called sponsors. So you may hear me use that term, or you may have heard that term as you're doing research. And those sponsors put together individual investments with predefined investment objectives, what they bought, what they're going to do operationally to grow the value of that property or properties over the hold period, and when and how they intend to exit. The right investor for a DST, the Delaware Trust is specifically suited to serve the 1031 exchange investor. It's oftentimes not attractive or suitable for a non-1031 exchange investor. The industry is focused on you. They're built for cash flow, and so they're stable properties that have tenants in place, that have rent contracts in place. There may be an operating objective to grow rents or raise rents to market or expand, but they're cash flowing on day one. Inherent to that is professional management. Okay, so there's large institutional managers who are routinely managing specific types of assets. It could be a commercial property or an office building or an apartment complex. But that professional management is oftentimes what people are coming to us asking for. Hey, I want to sell my property. I can't pay the tax. I don't want to buy something else. I'm done. I'm tired. I want to exit. I want to retire. Diversification, it can be viewed in two ways. One, you could sell your multifamily apartment complex and you could diversify into a basket of different DST offerings. That's one form. The other is that you may own multiple real estate investments locally or nationally, and you may be concentrated in residential or concentrated in Los Angeles. And so this allows you to start to piece part and take some risk off the table that's over-concentrated and expand it to other either asset classes or geographic locations. This is an off-market privately traded security, and so it is for accredited investors only. Most of you are. That's $1 million net worth outside of the home that you live in. There are some challenges. There's consults that we do, and we determine that it's not a good fit for investors. The number one challenge is illiquidity, and lack of control kind of goes with that. Many of you enjoy the option that you have currently to sell your property whenever you would like to, based on opportunity or based on challenge. The Delaware Statutory Trust is packaged and operated by an institutional management company who also control the exit. Again, that's stated in the investment objectives, and they have a timeline and a strategy around the exit that's well documented and well understood, and you would know that up front. But that becomes your liquidity event. And upon that, we're going to talk about on another slide what your exit options are. The potential advantages we've kind of covered already within the DST structure. These are nuanced when we're looking at individual investments and individual properties in specific locations. But generally speaking, we can achieve diversification. The professional management is handled. They're institutional properties that you may not have access to based on either total capital or just geographic reach. We can customize the equity and debt and the 1031 replacement requirement to leave you no boot. So oftentimes, if you're doing a 1031 exchange, you're either buying something more or you're buying something less than what you had. So you're either going to have to take out a larger loan or bring more capital to the table, or you're going to have to end up paying some tax. The DST, we can blend multiple DSTs together to allow you to have a 1031 exchange with zero tax liability. Any debt that you take on or that you replace through your 1031 exchange that's currently recourse to you is now non-recourse. The institutional sponsor is the one who's signing the debt. It's not the individual investors applying for a loan. So you can sell your property. Perhaps you're in a loan right now that's non-advantageous, or perhaps it's coming due with a balloon in the next couple of years. You can sell your property. You can replace it into a DST, replace your debt that's a liability to you, and become the beneficiary of the debt that's inherently inside of the trust. Whenever we're evaluating a DST, the properties are already purchased. Okay, so this institutional company, they're identifying, acquiring, doing their own diligence, and closing on properties, a process that you understand is difficult and takes quite a while. They're doing that before the trust is formed. Once the properties are granted to the trust and it becomes an investment for you, we can close escrow very quickly. That 45-day window is a challenge. You might go to Chris and say, hey, I'm ready to list, I think, but I'm afraid this 45 days is going to not be enough time to identify what I'm going to do with 20%, 50% of my family's legacy wealth. This becomes an opportunity to evaluate a market with a comfortable timeline prior to close and a very quick transition into a cash flowing opportunity. Two other advantages, estate planning and the 721 exchange, I'm going to talk about with the exit. So what happens at the end of the road here? A DST, once formed, is typically held for anywhere between 3 and 7 years. If there's debt, the terms of the debt are oftentimes going to drive the exit timeline. At exit, you'll have 3 options, maybe 4. I'm going to throw a 4th one in there that's not on the slide. When it's your time to liquidate, you're going to have 60 to 90 days notice to prepare for that event. You can cash out at that point, or perhaps it's your kids who'd be cashing out with a stepped up basis and no tax liability. You could do another 1031 exchange. You'll open an exchange with IPX or somebody else that's reputable and deposit your funds and have full flexibility to do whatever you want with your exchange. Buy something local, buy something that you own solely, or continue to roll into another DST or aggregation of multiple DSTs. Lastly, there's a 721 exchange. I could talk for 20 minutes about this, but to say it really briefly, some DSTs are acquisition targets for larger institutional REITs. So a real estate investment trust might look at a DST and say, this is a great part of my long-term strategy. They may even be affiliated with one another, and the DST becomes an acquisition pipeline that's baked for the REIT. If that's the case, you could have an option to roll your DST interest into a REIT and then continue to enjoy passive income and continued depreciation with an added bonus of liquidity. At that point, the redemption program of the REIT allows you to withdraw funds at whatever fraction you wish, exposing yourself to capital gains, of course, but giving you that control on the liquidity side. The 4th option, which is not on here, and it's fairly nuanced, but there are DST companies now that are releasing offerings that are targeted for a REIT exit, that upon that REIT exit allow you to refinance some money out. So many of you have grown your portfolio in the last 5 years by refinancing, taking that money and buying more property. This creates an opportunity for you to take maybe a property you've paid the loan off on completely. You get into a DST pipeline that's targeted for a REIT exit. That REIT takes over and allows you to pull some money out because the REIT also has debt in it. So that REIT can refinance your debt. You have a tax-free distribution of capital through a cash-out refi. I want to be practical. Okay, so ExchangeRite is one of these institutional companies. We use them quite a bit for diversification for 2 reasons. Number one, a lot of our investors are multifamily apartment owners just like yourself, with no exposure to commercial real estate. And commercial is a big bucket. It's got a bad reputation right now, largely due to office sector struggling. But there are commercial opportunities for you to stabilize and secure capital outside of Los Angeles County or San Bernardino County and participate in a completely different strategy. ExchangeRite's a company that puts together net lease portfolios. I'll talk about the tenants in a minute. They also have leverage or non-leverage, meaning they have a debt component, or you can participate in something that has no debt. They also have a REIT exit. They own about 1,200 properties across the country. They've been in operation for over a decade. They've never missed a rent collection from any one of their tenants, 1,200 properties. They've never missed a distribution, and they've always returned full capital outside of cash flow to investors over the last 10 years. Past performance, obviously, is no guarantee of the future. The net lease program itself is collateralized by assets that you recognize. These are investment credit tenants, single tenant properties, largely with net leases. They're responsible for all of the unforeseen capital expenses that saddle you from year to year. So they're taking care of the capital expenses. They're signing guaranteed rent contracts for 10 to 15 years. So completely different type of real estate investment than a multifamily investment. We are extremely careful when we're evaluating any company's acquisitions, but ExchangeRite focuses on essential businesses. So these are businesses that were open during COVID. These are recession resilient businesses. They're tenants that did very well during the mortgage crisis. They did very well during a variety of recessionary headwinds over the last couple of decades. Their balance sheet is national, and so the rent that they're paying you personally comes from a multi-billion-dollar investment credit corporation. ExchangeRite has a 721 option on exit, so this is a good case study to walk through. Here's an example of a DST that came out earlier this year or late last year. I'm actually not sure. You'll recognize the tenants, investment credit tenants that haven't missed rent payments in a decade. ExchangeRite put together a $71 million offering with 25 properties. So that's an example of diversification. We're taking a concentrated asset in one place, we're spreading it across 25 properties, 8 tenants, 14 states in one investment. The rent contracts are good for the next 9 years. This sponsor intends to hold this program for 3 to 5. Okay, so we've secured our capital by aligning ourselves with stable tenants, with stable income, and we've created quite a predictability for the next 5 to 7 years. And we're starting to plan for what happens after that. This is a real scenario, or it's very close to real anyway, that closed this week with an investor of mine personally. The investor owned a property in a living trust. Many of you likely have that as a part of your estate plan. Their motivation on exit, like many of you will be, to reduce the management burdens. It was an opportunity to sell, was strong. They liked the price. They could not afford the taxes. They couldn't stomach that. And they're focused on their kids and grandkids. Their motivation on acquisition was they wanted 100% tax deferral. They didn't want to pay taxes at all. They wanted 100% passive income. This is when they came to us. They wanted secure capital, stable income, estate planning. They sold for 2.8 and they had debt of $800,000. In your in your folder, if you want to, there's a blank worksheet that just kind of talks through a high level overview of what this looks like from a 1031 exchange standpoint. So their total replacement requirement was the net value of what they sold. They sold for 2.8. After selling expenses, their net value was 2.6. They needed to replace all of that with the 1031 exchange, but they also paid off their $800,000 loan. So at that point, they have, 1.8 total that they have, or 1.9-ish total that they have to invest in cash. They have to acquire a loan of $800,000, and then they're good. As we were working with them, we came up with a pretty cool solution. They worked, as we were talking, acquisition motivations change a lot in 45 days. I would say you guys are planning your retirement for your entire life. And when you get there, it's like a mad scramble to figure out what is the best decision for you. For them, they're working with a local broker. So in your mind, you could think of Chris working with a local broker and evaluating local properties, which we are all for, and it made total sense for their specific scenario. They worked with JRW to do 2 things. One, they worked with JRW to replace all of their debt. They did not want to apply for a loan. And they worked with us to invest alongside of ExchangeRite. And let's see, they did 3 different deals. Yeah, they were all ExchangeRite offerings of different type and strategy and scope. They picked up non-recourse debt to replace that piece. And they started with cash flow on day 1. So they're going to get paid on October 15th for all of the days that they're invested in September. They also were able to work with their local broker and take a really strong all-cash offer into the local market and close very quickly with an advantage. So they had no loan contingencies, they had nothing there, they had no cost on that side of things, and they were able to bring a really strong offer into a really tough market. And they're very happy with the acquisition that they had on that side. The outcome of this, that's interesting for you to consider, is their income increased. So a lot of you might think like, okay, well, 5% doesn't seem like a lot if you were looking at that last slide. The interesting thing is to run your own fundamental analysis on your current portfolio against the real value today. I mean, they were making like 2-point-something% because their rent didn't raise equivalent to the value. We've seen incredible value growth in the last 5 years. And so if they can exchange that for something stable, even at a relatively modest income level, they were able to increase their cash flow a ton on the DST side. Totally passive, and they intend to go into the REIT within 5 to 7 years. The reason that they want to do that is because they're working with their tax professional to take some long-term capital losses against a long-term capital gain slowly over time and liquidate that REIT modestly. They also don't want to take a massive hit in one tax year, which you would do if you sold your property and paid all. Even if you said, hey, I just want to pay the gain and walk away. I want to spend the money. I don't have heirs or beneficiaries. I'm not charitably inclined. I want to live on this in my lifetime. It's still an extremely strategically smart way to do it. You can take 50 grand a year for the rest of your life. You can take 100 grand a year for the rest of your life. You can decide exactly when you're going to liquidate out of that REIT. That's what they were focused on. I've got about a minute left. I'm going to put this up here. I just scratched the surface on the structure and the strategy. Everything that we do is focused on a nuance, individual investors' needs, goals, objectives. We do free consults. We do free scenario planning or analysis on your specific scenario. Happy to do that at any time. If you're considering retiring from real estate, if you use this QR code, you'll get my contact information. You can submit a question. You could schedule a call with me, or you could view a little bit more on our website. I expect if you are planning retirement, that you will have questions. We'd love to answer those. So thank you so much.
I hope you found that information informative. And if you're a landlord that owns multifamily properties here locally and you're in our area of service, essentially Los Angeles, San Bernardino, Riverside counties, and you are curious as to what would a DST mean for you, based upon the equity that you have in a property or properties that you own, if you were to take that equity and invest it into a DST, what would be your expected rate of return? We'd be happy to help you analyze that. That's what we do day in and day out, is help landlords analyze what strategies they have at their disposal to continue to grow their financial legacy, or to analyze how do they exit, sell their properties and exit day in and day out. We represent landlords like you in the purchase and sale of multifamily properties. And we don't stop there. Then we work on the strategy of what's going to be the next investment vehicle or vehicles to expand that financial legacy that you hear me talk about oh so often. If you have not already, be sure to subscribe to our channel. Give this video a like if you found it at all informative. Share a comment below. We'd love to engage with you, learn a little bit more about your investment strategy. And until next time, this is Chris German, the apartment dealer, wishing you positive cash flow, tenants who behave, and much protection from Uncle Sam. Till next time.